House prices are continuing to go down, builders are slashing prices right now, but at the same time, we're seeing that mortgage demand is starting to rise again as interest rates over the last month have come down significantly. Now, this has led many people to wonder, how much longer will we continue to see house prices decline, and will we still see a nationwide 2023 housing crash? Well, things are constantly changing with new data coming back, new reports coming back, and so in today's video, I'm going to share with you the most up-to-date information of where we're currently at in the housing market and what 2023 is starting to shape up to look like. But before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this, and with that said, let's jump into it. We just got the latest update with the housing market from Redfin, and it shows that the median sales price is continuing to go down. Now, if you go back to my content back in September and October, during that period, we were kind of seeing prices flatten out. And I was telling you then that you're gonna have to wait till around November, December time to see prices start to decline again. And that's exactly what we saw take place as we started getting reports as early as November that the prices were starting to go down again. Now, the reason I said that is because the median sales price is a very delayed metric. So those 7% rates that we were experiencing at the end of September wouldn't really get reflected until about a couple months later, after the houses have been on the market for a little bit. They've had a chance to go through the escrow process, which normally takes around 30 to 45 days. So ultimately, it makes it a very delayed metric. So even if you have high interest rates, it still takes time for that to be reflected in the median sales price. Well, we're continuing to see this take effect as we're getting numbers between November and December, and it shows continued declines in median sales price. And this is what I've been talking about on the channel recently, is there's still further price declines to come in the housing market, purely on the basis that we're still catching up with the median sales price to where mortgage rates were back in October. That's just starting to get reflected now. So according to this latest report from Redfin, we're now seeing that the median sales price on a nationwide level is now down 9.8% from the peak levels. So we're basically knocking on the door at double-digit declines on a nationwide level at this point. But it is important to note that not every market is going to feel this housing correction the same way. Whilst there's some markets that are already basically knocking on the door of a complete housing crash, there's other markets that may only be feeling a decline of maybe a couple percent. Now, the markets in particular I've been saying are going to see the biggest price declines across the nation are, number one, the pandemic boom towns, and number two, the very expensive markets, particularly like California, like Seattle markets, and some of those markets are already seeing significant declines. For instance, Austin, Texas is really feeling the worst of this housing correction so far, already down 19.8% from peak levels, basically at the point where you could technically call it a housing crash, which would be 20% or more. Now, Austin also happens to have a pretty high concentration of new construction in its market, with about 1/3 of all listings being new construction. So with builders being some of the forced sellers of this housing correction, that has a huge impact on markets like Austin that have a huge concentration of these builders as they continue to slash prices, up their incentives in order to liquidate their inventory. You see, as builders continue to sell off their inventory at a discount, that creates new comparables for the rest of the market. And if it's 1/3 of your entire inventory is new construction, that's not a good outlook for Austin. Austin also happens to have a lot of jobs in the tech industry, which has been seeing a lot of layoffs in the tens of thousands take place. So that leaves a lot to be concerned about with the future of the Austin, Texas market, but also with a huge concentration in the tech industry is San Jose, California, as they've also seen price declines of over 19.7%, again knocking on the door of what would technically be a housing crash. Then you got markets like Seattle and Boise. Seattle, another market with a high concentration of tech jobs, that's also a very expensive market. Boise, one of the pandemic boom towns. And so there's some markets that are clearly destined to see a crash take place. Well, what about a nationwide housing crash? Is that really still on the table? Well, the thing with a nationwide housing crash, in order to see a 20% crash nationwide, the problem is mortgage rates are going down right now. It's making housing more affordable again. And for every 1% drop we see in mortgage rates, we see buying power increase by 10%. So with mortgage rates having dropped over 1% so far, that's increased buying power by more than 10%. And then in addition to that, we've already seen prices decline so far about 10% roughly, affordability, which also increases buying power. Now, keeping that in mind, it's important to remember that affordability was basically the main component of what was going to trigger this housing market crash on a nationwide level. If we were going to see mortgage rates reach the 8% levels, the 9% levels, and some were even calling for 10% mortgage rates, which would have definitely caused a nationwide housing crash. So if that isn't going to be a problem anymore, and we do see mortgage rates stay around the 6% levels, maybe even possibly trend lower, well, that's definitely going to limit the downside we see on a nationwide level. Now, that's not to say there's certain markets that are headed for a housing crash, markets like Phoenix that have a huge concentration of iBuyers looking to liquidate their holdings. You got markets with huge concentration of builders that are constantly slashing prices as they have a massive negative sentiment towards what the future holds. And some of these higher cost markets, especially the ones with a huge concentration in the tech sector, as more layoffs come about with this economic recession becoming more of a likelihood. So those particular markets are definitely going to see significant declines taking place, but on a nationwide level, in order to see that nationwide housing crash, we really need to keep a close eye on mortgage rates. You see, my stance has always been that if we see mortgage rates trend back up again to the high 8% levels or even beyond that, then we're definitely going to be seeing a nationwide housing crash take place. But if we see mortgage rates stay put around these 6% levels or even trend down slightly from here, I do believe that's not going to be enough to pull it off. You see, we're already seeing buying demand pick up as these mortgage rates continue to trend down, and purchase applications are actually up 4% week over week, and they've been gradually going up over the last several weeks, and it's gotten us to the point where we're now at the highest level of buying demand we've been at basically since the month of September. So with buying demand increasing again, and we have active inventory and new listings continuing to trend down, we're seeing the months of supply also starting to take a dip. So that's bad news for anyone hoping for prices to crash on a nationwide level, because as you know, with supply and demand, as supply goes lower and demand goes higher, we see more upward pressure on prices. Now, for a good while, we were starting to see the months of supply climb, especially as we were at those 7% levels. It caused buying demand to go down so low that it was outpacing the lower inventory and the lower amount of new listings coming on the market, and so the months of supply continued to climb. But ever since we got the positive October inflation report back in November, that caused mortgage rates to react by declining in response to that report, and that in turn has led to more buying demand, which has led to lower supply levels. You see, you already have your everyday homeowner not wanting to sell their house, because why would you want to sell your house with a 2%, 3% mortgage rate to trade that in for something like a 6% mortgage rate? That doesn't make much sense. Plus, many homeowners are aware that even with buying demand going up, it's still not a great time to be selling your house. So when you have those new listings continuing to go down, but at the same time as that happening, you're seeing buying demand starting to go up, it just causes the months of supply to continue going down, which is really going to limit the downside of this housing correction. So that's where we're at with today's housing market. We just need to keep taking it week by week, month by month, and keep evaluating the new information that we get on a regular basis in order to get a better grasp on how much further house prices decline and really what the future outlook of the housing market looks like throughout 2023. But with that said, you can definitely expect that I'll continue to keep you guys posted with the latest on the housing market. And so if you enjoyed today's video and you gained some value from it, do me a favor and support the channel by smashing that like button. And if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Also, let me know in the comments below if you have any thoughts or questions. I'll do my best to get back to you. Finally, follow me on Instagram and TikTok at The Out of State Investor. And if you enjoyed today's video, I'm going to highly recommend checking out one of these two videos over here. And with that said, I'll see you guys on the next one.